Hello, everybody. Welcome to Friday, another show of Talk Money with Tom, and really enjoying these shows quite a bit. We've already got some questions that came in this week, and that's the whole object of this show is to try to build your education so you can build your wealth and really, secure your retirement. Katie here is on the show. You can send her questions right now if you want to ask Tom at talkmoneywithtom.com, and she's going to be our moderator, going to ask the question. Obviously, she'll do some follow-up questions. And then Eason's also here on the show, and Eason's going to be, here to as one of our advisors to ask follow-up questions. And you can feel free to ask Eason directly also. And so really the concept behind this is that, we specialize in retirement. I think this is one of the biggest goals that you'll deal with financially. And we've got some unique pieces in our background. For me, for example, I've done over 6,000, financial plans, and I meet with, hundreds of clients twice a year, kind of looking at their retirement. So I've been able to see some of the paths that really work in retirement and some of those that don't. And so this show is about showing you the right path. And so you can kind of custom design your retirement and really get something good out of this. And this, it really doesn't matter what age you are, whether you're 20 or 80, we're still all kind of working on our retirement goal. And so I think that's really important. So again, the whole concept here will be a lot easier for everybody to get kind of the videos that we post if you subscribe to the channel and you hit the subscribe button and the little bell. And we're constantly posting resources on there that you can use to kind of build your wealth knowledge. And if you don't want to do the subscribe, you can actually just get on our email list. We do a daily email with our market update for the day, as well as usually a bonus video. And you can just send in your email address to ask Tom at talkmoneywithtom.com, and we'll be able to get you on that email list also. So good stuff. Really looking forward to today's show. So what I want to start off with is just a summary of what's happened to the market as far as, I can see as far as that goes, and really excited about, what has happened this week. And, this is a historic time frame that I think is really interesting. The last time we had a reopening from a pandemic was over 100 years ago. And so, what's going to work and what's not going to work, for people like myself who are kind of fascinated by the markets, this is an incredible time frame. Very challenging, but really very, very interesting. So this week, really, we had some main catalysts that I think were important. Number one is what happened with the Federal Reserve and the Treasury and the kind of the comments that were coming out from that. And then number two, what is going on in terms of the market rotation. So different segments of the market and how fast things are rotating from one area to another, really at an unprecedented rate. So first of all, on Monday, the Federal Reserve chairman here in San Francisco, Mary Daly, made some comments that the Federal Reserve might be cutting back on their bond purchases. So the Fed is currently purchasing $120 billion worth of Treasury bonds every month in an effort to stimulate the economy. Well, she said they might have to cut back on that at the end of this year, beginning of next year, after we saw kind of these inflationary numbers come out last week. Well, this was earlier than the market thought, and so the market dropped. And then the Federal Reserve Chairman Powell, was testifying in front of Congress for 2 days this week. And he was actually much more positive, talking about inflation being, temporary, and very much repeating the same phrase over and over again, that the Federal Reserve is going to be there to try to get this economy going again and get back to a full employment situation. This is different than what the Fed has done in the past, so this will be very fascinating to see how this works out. So, and then, of course, today, Janet Yellen, who is our current Treasury Secretary, talked about the possibility of higher inflation, and the market fell. And so I think very important to understand that these people are in positions when they make comments, billions of dollars worth of money is going to change in the stock and bond market. So these comments are not made just, off the cuff. These are planned out. And I have no problem with this whatsoever. But this is a show, right? What you're watching right now is a show by the Federal Reserve and the Treasury. I would assume it's probably coordinated, but the whole concept behind the show is to get us as investors ready for the fact that they're going to increase interest rates at some points in the future, and that they're going to be cutting back on these bonds. Now, again, bottom line, we had 19 increases in the interest rates prior to the 2000 downturn and 21 increases in the interest rates prior to the 2008 downturn. So the fact that they're talking about interest rate increases starting in 2023, it's going to make some volatility for the market, but it shouldn't scare you. We haven't seen big drops in the stock market come off of a situation that we're in now where interest rates are nearly zero. So that was the whole story behind what's happening. I think it's important to understand what's going on there. The other area that's very fascinating is the rotation that's happening amongst different pieces of the market. So last year, I'll give you an example. I could go in and find something that was running really well for a 3 or 6 or 9 month basis. We could buy it and it would run for another 3, 6 or 9 months. I mean, clean energy is a great example. We bought that in May and June, and it ran all the way through to February of this year. So really fascinating, great time frame. This year, the trends are more like 3, 6, and 9 days. And so the rotation, and I've read lots of articles about this, the rotation is very, very fast. And so what that means is that you really need to kind of back up, or in our case, we need to back up, and you need to own the whole stock market. So I use a version of that called the Vanguard Total Stock Market Index. It owns most of the market. The ETF symbol is VTI. It's one of my favorite holdings. And for example, on Monday, I showed a little demonstration. I have a spreadsheet that I pull out of Morningstar with 2,443 different exchange traded funds. And so what I'm looking for there, I'm just looking for, what's trending and what's working. But I wanted to see those exchange traded funds that had consistently outperformed the Vanguard Total Stock Market Index. And so I wanted to see ones that had outperformed in every time period I had on that spreadsheet, which is 12 months, 9 months, 6 months, 3 months, and 1 month. Well, when you apply that screen, there's only 8 that make it through that screen. So only 8 ETFs have beaten VTI in all of those time periods over the last 12 months. Now, when I was doing this last year, there was hundreds of different ETFs that were beating VTI in that time frame. So it just kind of emphasizes the fact that you need to be broad market. So we're now 75% broad market indexes. S&P 500 would fit into that category with our portfolio, and the other 25% are in these targeted indexes. So with the targeted indexes, what we're doing now is we're shortening up the time frame for how long they have to be running before we buy them, and then maybe getting out of them a little sooner if we have to. If you got to play, if you're going to play that particular game, you got to kind of play, what's being allowed at that time. So right now, what's really working is real estate. So that's the big winner. That's worked really well for us this week. And then large growth stocks, specifically large tech stocks, and that's doing pretty well. A little bit of waning here at the end of the week, so we'll see what happens there with those. But and then ESG, which is a really great concept. They're taking exchange traded funds, for example, like Vanguard, will take the total stock market index, and then they apply an ESG screen. So there are companies out there that rate individual companies on how they do with the environment, how they do socially, and how they do with governance, how they treat their community, how they treat their employees, and they give them a number. And so then what Vanguard can do is take the total stock market index and just buy those pieces that have a particular number or higher, an ESG number that's a certain level or higher. The ticker symbol for that is ESGV, which we also own quite a bit of. So that's kind of what's happening is those 3 categories should be broad. Massive movement is happening much faster than normal in terms of that rotation. Maybe that changes. As a matter of fact, it usually changes. That's what's fun about this is that constantly different things are happening in the stock market. But that's what was going on this week. Really, the Federal Reserve, the broad market pieces, and which targeted pieces were working. And I think, really look forward to seeing what's going to happen next week. And obviously, I'll talk to you then when that comes up. All right, great. So let's get back to the Q&A session of this here. And I know we have some questions that already came in, so hopefully some others will come in today also. So feel free to send those in. It's never too late to send in a question or even an idea for a topic that you want us to cover at some point in the future. And so feel free to do that. So go ahead, Katie. What do we have right now?
Thanks, Tom. So right off the bat, we have a pretty meaty question asking, what happens if I live past my life expectancy in my financial plan?
Yeah, one of the ironies of financial planning is if you don't live very long, it's pretty easy to plan for that because, it just doesn't take that much money. And, we all want to live longer, especially with good health, but it's very, very difficult to make your money last that long, because inflation comes along and those types of things. So, what is your life expectancy is one starting question I would have. And so, we all hear these different numbers, but your life expectancy changes based on your age. So by the time you're 94, you still have a life expectancy, and it might be, 98 or 99 or what have you. And so what we do, for almost all the cases, unless somebody really decides they want to do something different, we plan to age 100. And it's not so much that we expect people to live to be 100, although we are seeing more and more of that within our practice. It is really just to kind of create a buffer for exactly what the question was, which was, what if I outlive my life expectancy? You do have to be careful here because you can put together a plan that's bulletproof for a really long period of time. And then if you don't really live that long, let's say somebody says, I want to plan to 110. Well, what that usually means is you have to spend less money. Or take more risk or do something else that you might not want to do if you're not going to actually live that long. So we've been doing age 100 for a really long time. It's worked out pretty well. People seem pretty happy with their outflows that they're able to kind of achieve from that. So again, there's kind of this balance of, if you said, hey, I don't think I'm going to live past 75 or something, you could spend a lot more money per year, correct? Versus, hey, somebody else says, hey, I want to plan to age 110, and then they would, to make that work, you'd have to spend a lot less, and so you might not have the lifestyle that you really, really want. So anyway, that's the balance that we're always trying to meet. But it's a great question. It's the number one challenge of financial planning. Is number one, we don't know how long we're going to live, right? We don't know that. And number two, if you do live for a long time, which people are starting to do more and more so, the challenge is making that money work, and it's a good challenge. It's something that you can usually meet, but it's a great question.
So just a follow up is, are there any indicators to look out for to ensure that I won't run out of money in retirement?
Yeah, it's it's a good question actually, and I would say that the best answer by far, and I've presented this multiple times on the show too. You want to have a financial plan in place, and you want that plan to be linked up with all of your assets so that it's just live. So it's basically there every single day. And so when the market changes, you can go in and take a look at it without having to go find all your statements and manually input everything. So that's very, very possible today, what we call live financial plan. And we have those for basically all of our clients. And what we then do is we go in and we say, okay, when you're looking at planning, you're looking at, what money's coming in from outside. So Social Security would be a great example, maybe rents or pensions and those types of things. What assets do I have? So hopefully that's all linked in, it's live. And then what am I pulling out the bottom? What am I living off of? What are my average expenses? What are some of the expenses that, I'm not currently having, but I might have, like dental or hearing aids and those types of things. You get all that in place and it's solid. And this is something we do every 6 months with my clients. And then you do what's called a Monte Carlo simulation. And so Monte Carlo simulation will run your plan 1,000 times. And it is considered the cutting edge of kind of retirement planning. And you really want your results out of that 1,000 times. You want to have success. In other words, be able to make it without running out of money at least 85% of the time. Most of my clients are above 90%. If you're below that, then we usually try to, continually adjust it. If you're not retired and you're fairly young and you're below that, that's not such a big issue. But once, as you get closer and closer, you want to get closer and closer to 85%. And then, as you get into retirement, you really kind of want to keep it there. And that's how you can kind of, I think that's the best way to figure out if you're going to run out of money, because it'll tell you, 5, 10, 15 years in advance whether you're going to run out of money. And it just gives you a chance to make adjustments as far as that goes. So it's a really interesting area.
So why is Monte Carlo so much better than like straight line? Because I know people always used to use straight line just to do to figure out retirement.
Yeah, I'll date myself here a little bit. really, laptops and handheld computers and the internet and what have you. A financial plan for me was conducted on a yellow legal pad with a HB12C calculator. And that was all straight line basis. And then we got spreadsheets. I had one of the first little portable computers that I used to use with the spreadsheets. But that was all straight line also. So what you're doing is you're assuming, a certain rate of return for your investments, usually on a consistent basis, and then a certain, inflation rate, for example, and all those things. And obviously, one of the real problems with that is that for example, the market, uh, I think you were telling me the other day, Ethan, that the S&P 500 has only hit its average in the last 50 years, just a few years. And so if you're using the average rate of return as your straight line calculation, it's not a terrible thing. It's something to look at, but it is not going to be nearly as accurate as a Monte Carlo simulation, which can make some random assumptions about markets being great one year, terrible the next, that kind of stuff. And so that would have a better chance of replicating actual life. And that's why Monte Carlo simulation is so much more used now than the straight line calculation. We still can see the straight line calculations. I still look at them once in a while. They're interesting, but they're not all that relevant to compared to the real world.
Yeah, and another thing that's really nice is with the simulation is we can also test like big events that have happened in the past, like say inflation jumps to 5%, or you have another great recession, and we can test what happens to your portfolio and your plan if you have that event starting tomorrow, essentially.
Yeah, it's my favorite piece. So I'll do a baseline, Monte Carlo simulation. Hope it's over 85%, that kind of thing. And then we'll go stress test it. So we'll then run a Monte Carlo simulation where the computer knows we're about to have the Great Recession, a big 60% drop or what have you. What happens? What's your percentage of probability of success out of those 1,000 times when you're standing in front of a known downturn? And so, what happens to your overall situation? And then the next situation is, like you said, inflation. So it's not been very high, but now all of a sudden it's higher again. So maybe it stays, maybe it doesn't, but let's just say it does. What would happen if you had 5% inflation for the rest of your life? How does the Monte Carlo simulation work for that? I like those two a lot because they basically show you how much stock you need to have in your portfolio. If you're doing really poorly in the Great Recession one, it's because you might have too much stock. If you're doing really poorly in the inflation one, it might be because you don't have enough stock, because that's one of the things that helps keep up with inflation. And so that the combination of those two kind of helps me craft your overall recommended exposure to the stock market, which is one of the key pieces that we deal with. So yeah, that's a great piece of that, actually. I love that.
Wow, anytime you talk about the Monte Carlo simulator, I am just absolutely floored by how powerful this is. It is just so cool that you
Yeah.
get to use that and put in all those variables.
Yeah, we've been doing it for a while. It's not brand new, but it's definitely it still works. I feel very confident, when I'm sitting with a client that, that we'll know what's happening if they're going to run out of money. We can tell pretty quickly, and we can make adjustments. And so I think honestly, and I'll blow my own horn here, but I think sitting down with an advisor every 6 months is another way to make sure that and doing a financial plan and having that advisor interpret that financial plan is another really good way to make sure you don't run out of money. I mean, honestly, you can do a lot of the stuff yourself, but you probably won't have the opportunity like I have to do 6,000 of those plans and look at them I look at them every day. Day after day after day. So, being able to interpret and see, what actually happened. So, we were doing those during the 2008 downturn, actual live. So, we can replicate it now, but I was there doing that, this, it really helps. If that's one of your main concerns, and it should be, because running out of money when you're 80 or 90 years old is just brutal. What are you going to do at that point in time? So, making sure that doesn't happen should be part of your success path that you're working on for your retirement planning, no matter what age you are.
So Ethan, we have a question for you asking, how does time horizon of my goals affect the risk I should take?
So time horizon is kind of like that period you have between now and your goal. And so if you have a short time horizon and you can't easily replace that money, you have to scale back the risk. But if you have like a long time horizon, say for retirement, and you're 40 years out, you can scale up that risk because that time will, over time, your volatility will go down when you have that additional time. Like the market, becomes closer to the mean essentially. And so there's also that scaling down of risk as you get closer and closer to the goal. Like for college planning, when the child is a baby, you start super aggressive. And then when they get closer and closer to college, their senior year, you're going to dial back that risk because you want to keep that principal so you have the money there when you need it.
Yeah, it's a really interesting question because if you look statistically, I think you go back to 1880 and look at the market as a whole. It's only had one 10-year losing period. I think that was 10 years that ended in 2009. And so, time kind of alleviates some of the risk. But if you look at every 1 year period, there's a lots of 1 year periods where you lost money. So, if you're trying to save for something in the short term, the stock market can be a really brutal place to do it. Especially 100% into the stock market. Now, the one area that has actually this weird crossover is saving for a house in an area where the house prices are really high, and it's very competitive and everybody's putting in multiple bids. I've seen a lot of people take some really crazy risks on a piece of their investment, to try to get their down payment up or what have you. And if it doesn't work, then, they have to wait longer to get their house. But so, yeah, it's very fascinating. The last piece I'd say is that definitely you have to factor in your own risk tolerance. For some people, no matter what, time period you're talking about, whether it's long or short, they want to be really conservative, or in some cases, they want to be really aggressive. So that's another piece too, is just your own personal outlook on risk and what you can tolerate. But yeah, the numbers basically don't lie. If you got a short term, be careful with investing in the stock market.
Yeah, I have a friend that, he's very conservative with his investments and he's only in his 20s,
Yeah,
but he's 40% stock and 60% bond, which
yeah,
is, but he believes that he can just earn enough money that he'll be fine,
yeah.
essentially.
Now, yeah, risk is not directly related to age. People think it is. I've seen people in their 20s that are super conservative. My most aggressive client is 93. And so, that's just, he's always been that way. It's just what he does. And so, yeah, the part of that, your own risk, your own kind of ability to handle that risk. I'm fairly aggressive. I've been doing this my whole life. I probably won't change too drastically, as I get older. It's sort of what I do. And so that's true for lots of different people.
So we have another question in asking, do you have any recommendations for good companies for investing in gold?
Oh, investing in gold. I will say one thing. I have never had gold in my portfolio in my 35 years. I've looked at it again and again and again. And, the volatility is higher than I usually like to put in the portfolios just because of, again, I'm dealing with somebody's life savings. So I have to be super careful with that. And I don't want to have, that blow up on me as far as that goes. And gold can move pretty quickly. But I'll tell you what, I would probably be looking at an exchange traded fund instead of an individual company. And that's an area that I happen to really, really focus on. But there are a couple of, you can buy GLD is the symbol, and GLD actually buys gold and holds on to it. And so you're getting a share of that gold, pile wherever they have it. Um, and so it directly reflects the price of gold, minus some fees or what have you. So that's a super popular investment actually for directly owning gold. But a lot of people can make an argument for owning gold miners, because there's other aspects to that in terms of just being a business and whether they make profits. And there's another exchange traded fund with a ticker symbol RING, RING, that I've been following for a long time also, that's had some interesting movement to it. Very, very heavily correlated to gold, but that's just another, instead of having the pure metal, you can buy the miners that way. So those are the two big ones that I followed over the years. And I think they're probably worth, looking at least. And it's fairly efficient. You can get those in your portfolio. I mean, I've had clients that have requested gold, and we put it in there. And we do client requests. So if somebody wants something, we'll do it. We just kind of carve it out. And I got all kinds of, different pieces that people wanted, that we purchased, and just kind of we set it to the side, in essence, in the portfolio. We keep our, balancing and all that stuff, away from it, and just watch it and see how it goes. So if somebody really wants gold, we could do it. And we've done that in the past.
So what are your thoughts on, instead of like, these ETFs, going to gold coin or like collectibles to actually target, gold and silver that way?
Yeah, that's how I would do it personally. I have one client who's really into gold coin collectibles. I think that you get kind of a combination, because collectibles are hot, right? And so there's an aspect to that. It's rare, and so it's not just gold. It's actually a coin minted in San Francisco in 18 something, or whatever it might be. And so and it has provenance and certain quality. I would definitely be looking at that. I also will disclose that I happen to like collecting coins. I haven't done it in a long time, but it's one of my favorite things. So that's how I would do it. There's some problems with it, in the sense that, where do you keep them? Having tons of money in your house is not a good idea. So, that type of thing, you gotta have some way of dealing with it. And, if you're going to buy a $20,000 gold coin from some collector up in San Francisco, I get really nervous when I have that kind of money in my hand or pocket, honestly. So that part of it would be a little scary to me, and I haven't done it yet. But I think it's valid. I think it's worth looking at. I mean, just again, you get the collectible aspect of it too, which is kind of fascinating.
Yeah, but one issue with collectibles is, it's harder to sell a coin than it is to sell an ETF, and
Oh yeah.
you can just move that ETF in a snap of your finger, essentially.
Yep. 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 Exactly. And that's the reason we have so much more in those types of things. Yeah, exactly. Ease is important, but again, as a hobby, I think about it. I'll probably do it someday, but haven't done it yet. I'm too busy looking at ETFs to do anything else, to be honest.
7 days a week.
Yep.
So we have another question in asking, what is a controllable income versus an uncontrollable income?
Oh, wow. Okay. That's actually a really important component, especially in tax planning area. So a controllable income versus an uncontrollable income, and you need to be able to identify those to be able to really figure out your tax planning strategy. Um, they have a thing that I heard about years and years ago. It's called Rockefeller's Rule. And this is supposedly a quote that was attributed to John D. Rockefeller. And the concept is to have the most efficient tax structure, you should not have more taxes on your tax return than you spend in any one year. So again, to have the most efficient tax structure, you should not have more income on your tax return than you spend in any one year. I used to give seminars called the 7 Steps to Retirement Success, and this was one of them. And so one of the things that happens there is, in order to do that, you need to be able to identify your controllable versus uncontrollable income. So an uncontrollable income would be something that's coming in that you can't really stop. I mean, you never really want to stop them, but from a tax standpoint. So Social Security would be a great example, or pension would be another example. And I often put like rents into that, for example, or if you're getting royalties for a textbook that you wrote, those type of things. Now, rents are theoretically controllable. You could sell the property and stop the rent, but usually that's such a big job and people don't want to do it. I'll call that uncontrollable. So let's say that adds up to 50,000 and I'm spending 100 just to make up a number. Now I want to identify the other incomes that I have. And let's say my total income's 150 altogether. So I got another $100,000 worth of controllable income. And so these would be things like interest income from CDs or savings accounts, dividend income, capital gains that you're kind of consistently generating out of taxable accounts. These are things that you could handle in different ways. and try to reduce that taxable income down to the 100,000 that you're using. And so most of the controllable incomes are incomes coming off of investment types of assets. And then you can do different things to, defer capital gains and buy and hold. If you bought some gold coins, you can hold on to them until, so you don't have to pay taxes, even though it could grow. And so really it's about matching up that income source to, how much you're spending. And so that's what they're talking about there when they're talking about controllable versus uncontrollable incomes. It's a really interesting area, actually, and it's part of tax planning. Tax planning is different than tax preparation. Most people are familiar with tax preparation because you go to see your accountant and you get, your taxes filed in April or what have you. Tax planning is taking a look at all of your income sources, controllable and uncontrollable, and seeing what happens, all over your entire lifetime, all the way out to age 100. You get to 72, you got another uncontrollable income, and that the required minimum distribution that has to come out of your IRAs. So part of tax planning is dealing with that. And then what strategies can you do today to reduce your overall tax costs throughout the rest of your life? You'd be amazed at how much difference that could make, actually. And hardly anybody really does tax planning. And so that is the first step, is to kind of identify that controllable versus uncontrollable income.
Is that why?
Go ahead.
Is that why Roth is so powerful? Is because essentially you can get money without actually creating any kind of income for yourself.
Yeah, if you have, and this is why I converted everything I have into Roth, last year and this year, because it just gives you massive flexibility. I can generate whatever income I want out of my Roth accounts, and that none of it ends up on the tax return. I can get stock market rates of return for tax free, and so there's some, pros and cons to that. But it's also part the Roth now, and the ability to convert from an IRA, a regular IRA or regular 401k into a Roth, IRA, is a part of tax planning. And so that's something you have to take a look at, because let's say somebody has a lot of money in 401k, and when they retire, all of a sudden they're going to have this massive, massive income, uncontrollable income after age 72 because of the required minimum distribution, right? And so the Roth then becomes a very powerful tool in a tax planning base to try to start moving some of that out of the IRA to control some of that income in the future. And it's math. We have programs that'll figure out how much to move and what makes sense, what doesn't make sense, and what have you. There's lots of tricks to that to make it work just right, but that's definitely on the success path for retirement. Very important.
You had mentioned pension being an uncontrollable income. Should pension be included in a net worth statement?
Pension really, net worth is generally an asset. So, a capital asset like your house value would be part of your net worth, for example. The rent that you're getting out of that house is actually on an income statement. And so a pension's an income. So theoretically, in the world of finance, that's on an income statement, not on a net worth statement. Theoretically, you could capitalize the value of that and say, hey, I'm getting 20,000 a year from my pension. If I live X number of years, here's what it's worth. But usually that's actually just an income area. And when I say uncontrollable, I don't mean it to be a bad thing. Pensions are awesome. Some of my best clients that are happiest in their retirement have really big pensions. But it just means that, once that pension starts, it's going to end up on your tax return. There's no way to control it, to move it off like you can some of these other incomes. So yeah, there's just a differential between, how you would look at that. But yeah, it's a good question.
Yeah, but having a pension is such a powerful thing. That fixed income, you don't have to worry about the market when you have a pension.
Yep.
It's so powerful.
Yep. Yeah, that's exactly right. And that's where Social Security comes in too. Even if you don't have a pension, being able to maximize Social Security is a huge issue. And so that I think is really important.
We have another question in here asking, are we in another tech bubble, just like the previous tech bubble?
Yeah, I've been asked that quite a few times, especially last year when things were really hopping. Um, I said no last year, and actually I was right, because if we were in a tech bubble last year, it basically burst middle of February, and the whole market would have fallen apart like it did in 2000, and it didn't. It just kind of rotated out into a broader segment, which was great. So, yeah, I was here in 2000. I would say that the thing that reminds me the most of a tech bubble is cryptocurrency. And I always like to tell this story about one of my clients that called me from his car asking me about a stock. And this is in 99, I believe. And he wanted to buy and know about bingo.com. Okay, so I look up bingo.com. It's registered in Florida. It had just become IPO like 9 months ago. It went from $1 to $9. I mean, that's a huge run. And that's why it caught his attention, obviously. But when I look behind the scenes, the company did not have approval on a regulatory basis to do bingo online. And so they didn't have a product. There was nothing there. And the only hope you had if you're going to buy bingo.com was that somebody else would buy it for $10 if you bought it for $9 or $11 or something. Cryptocurrency is exactly the same. There's nothing behind it. There's no use case for it right now. They talk about being able to use it as a digital currency. It's been out, Bitcoin's been out for 12 years. It's still not really being used as much as it should if it was really going to be effective. Compare that to, say, Venmo, which has been out less than 12 years, and now it's really working in terms of transactions, on an electronic basis. And so that's the area that I would say is the most like that. And that has started to kind of crater here. We've been talking about cryptocurrency just about every show. Something comes up in that area. I just read an article saying there's 8,400, cryptocurrencies right now. Again, that's a lot like the dot-com bubble because you could make up a company, bingo.com. I'm going to make this up and I'm going to register it and I'm going to go out and go IPO. And somebody made money on that. Like it wasn't my client because I didn't let him buy it. Luckily, because it went bye-bye. And so, yeah, I actually the overall stock market that we're in right now is extremely reasonably priced in comparison to what we were looking at in 2000 at the top. The PE ratio was really, really high compared to now. And so, no, I don't think so. I think in certain areas, I definitely felt like we were in a bubble in that clean energy, innovative technology, genomics area, the ARC funds, all of those things which peaked out in February, but it didn't bring down the whole market. And hopefully cryptocurrency doesn't either. But it's a good question, but I don't think so at this point in time. We could get there. I'll let you know because I was there. I remember this is not like that. It's not, except for some areas like crypto.
Do you believe that over time the fragmentation will and like all the companies will consolidate into a couple coins essentially, and that's when it's a good time to start investing?
Yeah. Yeah, it's a good point because think about it. I remember during the dot-com bubble, there was so many companies, right, coming out and, with a product or no product or what have you. And now we have Amazon. What a great, find that was. And that came out of the dot-com bubble. So somebody's going to survive in the cryptocurrency area. I remember reading articles about Detroit in the very early 1900s when the cars were coming up. There were over 2,000 car manufacturers in Detroit at that time, and now there's three, with Ford and General Motors and whatnot. So really, I think that's probably very true. And I actually think cryptocurrency sticks around, at least in a few areas. There's some potential money to be made there. And, like Amazon, and I don't know which coin it'll be. There's 8,400 of them. That's an incredible number. And, which one actually works and sticks around, we'll see. I will say one of the things that did happen this week that I didn't mention in my weekly summary was that Chairman Powell of the Federal Reserve mentioned that the dollar, the U.S. is working on a digital currency. I call it the digital dollar. That's a big threat to cryptocurrency. And he said that you wouldn't need cryptocurrency once they get their digital currency out, which I thought was kind of interesting. So he's already doing a marketing push for this. But people buy cryptocurrencies for other reasons. And, having U.S. backing actually isn't an advantage for some people. And so that, it'll be interesting to see how that plays out. But there's about to be a lot of competitors coming in. And I do think it'll winnow it down to, a less than 8,400 are going to survive.
We have another question in saying, I own a home and have a little nest egg. Is Social Security going to be enough for me to retire on?
Yeah, it really, I guess it would depend on how many roommates you can get into that home that you own to make it work. Now, you have to take a look. I'm kidding, but one of the things that's important to understand about Social Security, obviously, is that it isn't designed to be the key issue for your retirement. It's not supposed to be like everything. Unfortunately, for the average American, it's close. If you look at the stats, people over 65 on average have 49,000 plus Social Security. So, for a lot of people, Social Security is the key, and it's a really awesome system. But you're probably going to need to get a little creative, either with your expenses, if you're going to try to live off of Social Security alone, or with your, other income potential sources in order to really make, a retirement work. It's awesome to have a home that gives you some flexibility. You can do a reverse mortgage. Maybe not the best idea, but it's possible. You could, maybe downsize. You could rent out rooms. There's some things that you might be able to do if you have a home, and I think that's awesome. So if you have a home and Social Security, you're going to have to take a look at some kind of out of box thinking to a certain degree to really make it work. Social Security does have a cost of living increase, which helps, but it doesn't really keep up with the true cost of your living. It does grow, which is better than nothing, but that's going to be one of the challenges. If you live a long time, your standard of living is going to continue to drop back. So I would be getting really aggressive on the creativity on how to generate income besides Social Security. And there's a bunch of ideas out there.
Yeah, especially if you're living in the Bay Area, it'd
Yeah.
be pretty tough to survive on Social Security and a
Yeah.
small nest egg.
Yeah.
And if you have a home here, maybe that's a big part. It could be a big part of your plan where you can use that equity to, maybe move to a lower cost of living area.
Yeah, exactly. I have clients do it all the time. We have clients in 26 states outside of California now. Some of them move just because they want to move, but some move because they really needed to move. Exactly that. They'll move from here to Austin or something, just because they can get a place for cheaper, and then they keep the difference. And now they've got more than just Social Security. They also have this capital that they can start to generate income off of, as far as that goes. So I think there's, that's a valid point. Yeah, exactly. It's an asset. Having a home is awesome. All
There's
right.
about 2
Go ahead.
minutes left.
Okay, go ahead.
I was just going to ask one more question.
Sure.
Asking, what is an early IRA withdrawal?
Oh, so before 59 and a half, if you take money out of an IRA, you have to pay a penalty. It's a 10% penalty. And then sometimes your state has a penalty also. And then you have to pay the taxes on it. And so it's really onerous to take money out. But let's say you're retired at 55, and most of your money is in, retirement plans like an IRA. They do have a thing called the rule of 72T, and it's a really handy program. Actually allows you to take money out of your IRA before 59 and a half without any penalty. There's just some, pieces that make it a little bit difficult. Number one, it's a pretty strict formula. There's 5 different options that you can choose from for getting the money out at different levels and what have you. So that part isn't too difficult, but you have to know that. And then the second thing is just you have to take the money out. Once you pick that program, you have to follow that program for 5 years or until 59 and a half, which is ever longer. So if I retired at 55, I'd have to do it to 60, right? If I retired at 50, I have to do it to 59 and a half. I have to do it for 9.5 years. And so, it's a little restrictive as far as that goes, but that's a great way for people that don't have the assets outside to support themselves during that first portion of retirement. That's how I would do it.
And two, if you're laid off from a job or leave a job at 55 and you have a 401k, I believe you can also withdraw without a penalty.
Yeah.
There's like that caveat, essentially, if you're having trouble finding a job because of just your age.
Yeah, that's a really cool piece that they've added to that to allow for some liquidity, because it's a problem. I mean, in 2000 in our valley here in Silicon Valley, we were kind of the epicenter of that whole downturn. And there were an awful lot of kind of people in that mid 50s range that got laid off, and then there just weren't any jobs for a really long period of time. And so, they went from these great paying jobs to no job, and having access to a 401k would have been really, really useful. So that's good. Okay, well, everybody, thank you so much for coming today. Really appreciate it. Love doing these. Again, we'll be here next Friday. If you want to get notified, go ahead and subscribe and hit the little bell when we put videos on there, or send in your email address to our email here, and we'll put you on our email list. And so want to thank everybody so much for coming, and I look forward to seeing you next week. Thank you.